Thank you, everybody, for tuning in to the keynote battery metals panel for the Minds and Money event online. Hopefully, one of these days we'll be able to interface face-to-face sooner rather than later. But in the absence of that, this will have to do. And so for those of you I haven't had a chance to meet, my name is Chris Berry, based out of Washington, D.C., and I run my own strategic metals advisory firm. Been involved with Minds and Money for a number of years now, so it's great to be back as a moderator for what I think is going to be a really, really interesting panel, given everything that's going on geopolitically, economically, so on and so forth in the battery metal space. And so with that, you're clearly not here to hear from me, you're here to hear from the panelists. And so what I will do is just give a very brief introduction of everybody, and maybe once they start speaking, they can go a little bit more deeply into their backgrounds. But without further ado, today with us, we have Per Wimmer, Chief Executive Officer of the Wimmer Family Office, Mr. Matt Fernley, Managing Director, Battery Metals Review, and also the Head of Research for WestBeck Capital Management, Jessie Chen, Director of Long State Investment, and last but certainly not least, Aline Carnizelo, Vice President of the Investment Team from Pala Investments. And so with that, let me go ahead and pull everybody up so I can just see who we're dealing with here. Again, as I mentioned, look, guys, there are a lot of topics that we can take the next 40, 50 minutes and discuss. And I do want to pick your brains on a number of them, whether or not it's risks, supply chain development, geopolitics, of course, ESG is, I think, one of the hottest or most important topics in the battery metal space going forward. But maybe just to start off from a macro perspective, look, I don't think there's anybody that would disagree that we're in a raging bull market right now for the battery metals, for the supply chains. It looks to me like this is going to go on for a while. This is not sort of a 2017 to 2019 head fake. I think we're in a much more structural bull market, which is very encouraging. But that said, given all of the excitement and positivity, I'm curious to know what you think, and we'll go around the horn here on the panelists. What are some of the risks, given where we are in the space right now? What would investors sort of be overlooking or missing, given a lot of the positive chit chat and chatter that we see? Jessie, do you want to start us off, maybe?
Sure. Thank you, Chris, for the introduction. And my name is Jessie Chen. So despite the COVID-19 impact on the global auto market, we saw rapid growth on the EV sales and driven primarily by Europe. However, the speed in the rate of the European EV sales could slow within the next few years due to the worldwide deficit in lithium needed for car manufacturers. And according to the industry analysts, the lithium demand could triple by 2025 to 1 million tons per year, and then double again to 2 million tons per year by 2030. And we understand each lithium mine, they produce 30,000 tons per year of the chemical. With that meaning, approximately we need 4 mines per year to maintain the pace of demand. And on the supply side, due to the low prices through 2019 and 2020, we saw the capacity cut and also project delays. That's why we see the supply struggling to match the demand growth. As a result, we expect the market have a deficit in lithium market has a deficit in mid-decade, and we don't see any material increase in capability until 2023. So I do see the rate presented to long-term supply by under investment in project delays, maybe some soft issues such as permitting and approval.
Great. And, you talked about supply there, and Matt, I know you've written a lot about, I think the way that you kind of phrase it is the number of green bushes necessary to hit certain electrification goals. Maybe if you could talk a little bit about that, but also just keeping in line with sort of the risks that you see at this point in time.
Yeah, so I echo what Jessie says, and I think that supply is a core risk for the electric vehicle space. I mean, we've written in Battery Materials Review about the amount of supply that needs to come into the market. As you said, 7 operations the size of Greenbushes by 2026, 2027, and then maybe another 2 per year after that. And we're nowhere near having that amount of supply to come onto the market. And then what does that mean for the market? It means realistically that we can't take our EV sales forecasts up any more than that. So some of the numbers that people are putting in for, you know, how many EVs we're going to sell by 2030, totally unrealistic. They're impossible at current levels. So that's a real problem. And I mean, Jessie's point about government support around the planning mechanisms for new mines, you know, particularly in the US and in Europe, we really need a lot more support at a government and a local government level for the mining industry if we're going to bring forward the sort of supply that we need to see. The other risk, and I would want to talk about, and we've seen it a lot in the market in the last couple of weeks, is obviously the COVID risk. In the near term, in terms of the fact that obviously the market has got the willies because it's worried about near-term growth. But for the sector specifically, also there is a huge risk because of labour shortages, particularly in Western Australia, to a lesser extent in Latin America. And I perhaps it's not widely known outside the battery materials sector, but a fair amount of new supply in lithium, in nickel, in other core battery materials is going to come out of Western Australia. And in Australia, they shut down the individual provinces when there are COVID flare-ups. And in fact, they have done that in Western Australia now. And that's one of the problems that the lithium industry is having in terms of building new supply, because they cannot bring labor in to build this new supply. And as a result of that, supply growth is probably offset by 6 months. Now, in a oversupplied market, that wouldn't be an issue, but in a very tight market, it's a huge risk. So I think the market is maybe not anticipating the risks that COVID is having on this industry as well.
Per, your thoughts, please.
I would completely concur with Matt and take it even one step further and even take it outside the battery metal space specifically. Because because it's not immune, obviously, to general global dynamics, and there's a massive coming out of COVID, where everything has been constrained, cut down, downsized, et cetera, from a manufacturing perspective, and a general global economic perspective. There is so much lack of capacity in the system, so much inefficiency in the system, that we see these enormous bottlenecks, whether it being chips that can't be produced fast enough to get into the system. I mean, Toyota, for instance, I hear, has had to cut their car production by 30% because of chip shortages. I mean, it's unheard of. I mean, that's a lot for a big global car manufacturer that otherwise have a huge bargaining power. And that, of course, in turn, will affect the growth of electric cars. Unsurprisingly, I mean, these things are completely linked. So I think you've got to start with the global picture. Container shipping, Asia to Europe, the rates have gone through the roof, absolutely through the roof. One of the biggest container ship companies in the world is Maersk, which happens to be Danish, where I'm right now. Their headquarters is just down the street from where I'm right now. They have made exit profits this year, way in excess of what they made the entire last year. I mean, that they're printing money at the moment, and that's because of inefficiencies across the board. And those inefficiencies coming out of COVID, combined with the fact that you have now a relatively modest COVID growth to suddenly a very steep growth curve, because now everybody's getting back to work, everybody wants to do things. And then on top of that, you have all these political policy initiatives putting in regulation deadlines on electrification. You got to have electric cars in the UK by 2035, etc. So you've got all these pressures as well, adding to it. And then on top of that, you've got the labor shortages that Matt was talking about, which is massive and a really big problem. You can't get lorry drivers in the UK at the moment. It is impossible. Even if you're an Amazon worker looking to ship stuff in their warehouses. You get a £1,000 sign-off bonus today if you show up for work. It's incredible. So you have all of these inefficiencies, and this will affect the demand part of it, because there just isn't, the supply chain is inefficient, it's not working, and therefore all these estimates, like Matt was talking about in terms of expected demand realization, it's just not going to happen, because there are massive supply chain issues that needs to be sorted out first. And then we can talk about these specific supply issues relating to lithium mines and graphite mines like Jessie was talking about, and then that comes on top of it. So I would take a very big step back and a big word of caution when it comes to estimates for how fast this thing is going to evolve, because it's going to be a lot slower than you think.
Yep, I would agree. And I want to come back to the supply chain build out, and I want to get everyone's views on how to do it and what it looks like 5 to 10 years out. But before we do that, let's finish up maybe with Aline, your thoughts on risks. What are you sort of seeing from your perch?
I agree with all the panelists. I may have a different view in terms of the longer term. I believe that this supply chain disruptions is unfortunately will take longer than what is expected right now at the market. I think everybody thinks this, for example, as mentioned, the chip shortage will be resolved in the next 2 months. And it's clearly, if you're looking to just the specific companies that are producing these, and you look at their pipeline and the waiting list, it is very clear that will go all the way to mid next year, the tightness. So it will take longer, that is for sure. But in the longer term, I guess I'm more optimistic than the rest of the panelists, because I do believe prices will react and supply will come. We have seen it time and time again in these resource spaces. You know, we built a China, we doubled the amount of iron ore that we produce in a certain time of period. So when it's necessary, it comes. But I think the bigger risk and the fact that we had to address is that we will come at very high prices, unfortunately, because the industry is not preempting. Well, for us and everyone in this panel and everyone that has an educated view of this know that it's coming. It's no doubt now. We passed through the phase that it would be or not be electric vehicles. The plants are being set, the technology is set, the models is set. It's a mathematic thing of how many you're going to do and how much you're going to need it. And in mathematics, you can then reduce that. This is the missing gap, it's a certainty. So I think the main problem for me is that it's going to come more expensive than it should have, because we are not preempting this supply. And then we go into the affordability of these vehicles, because we want to get to net zero. We want to get there in an affordable, inclusive way. What happens if then it's so expensive that becomes, you know, it dislocates from a normal car? And that's my worry, is that at what price will this happen?
That's a great segue, and I'm glad you brought that up, talking about net zero. Aline, I know you've done a lot of work looking at ESG and how that impacts the industry or could impact the industry. And that's kind of my next theme or next topic for the panel. And I'd like to start with you. I just want to get your thoughts on how this supply chain, whether or not it's automotive or energy storage, how is it supposed to handle the ESG challenge, where, again, there are some relatively, I would argue, tight deadlines, whether or not it's 2030 or 2035 to get to net zero, whether or not that's on the country or company level. I mean, how realistic is that? Is that going to your point, make this more expensive and impact the overall economics of decarbonization? I mean, how do you think companies first, and then maybe taking that one step further, how should investors be thinking about ESG and how it fits in this supply chain rebuild?
Yeah, sure. So in my opinion, ESG, or going to net zero, is the largest challenge of our generation. There is nothing that it will be compared to meeting these targets. It is incredibly challenging for two reasons, not just the volume you have to produce, but obviously you don't want to produce electric vehicles in an unsustainable way just to produce the volume. So you want to produce the volume in a responsible ESG matter way on the supply chain, and that adds another layer. So the way that we look here internally is that I take any, call it pre-feasibility study, and I add quite a big, large 20% addition or environmental charges overlooking, because this is just the way it is, right? You cannot produce as you did before. And at the end of the day, it's a price to produce sustainably. And I think that's why, going back to the price and the inflation thing, decarbonization is going to be extremely inflationary until we hit the point that these technologies are, efficient as it is with the ICE vehicles and the supply chain. And on top of that, some particular metals, as we all know, are concentrated in certain jurisdictions that is really hard to reach certain standards that we want to reach. So I think the challenge here is enormous, and the way to do it is project by project, and to look into certifications, use the technology that we have now. I think blockchain, for example, is a technology that could be leveraged for these challenges of tracing where materials come from. Green premiums will be a reality. We're going to have trading as green premiums as much as you're going to have trading for the underlying commodities. And we've got to stop thinking about commodities as one category. It's going to be green commodities and normal commodities, and the green premium will only increase through time. And it's going to be at the end consumer to really demand the information of this, where this car come from, and really push the green out of it. And I do believe it's already on the way.
Yeah. All right. Other panelists, Per, any thoughts on ESG and how it all is supposed to fit together?
Yeah, no, I think the impact on ESG in the investment community, which is a growing trend, there's no doubt about it. It's LPs are increasingly looking at that as a serious consideration, and it's just part of their investment mandate. And also when they allocate funds out to external funds, then that in turn invest in these things. It just is a part of daily life increasingly. I think where we have seen the biggest impact of all of these policies in a very concrete fashion has been on the oil and gas industry, where certain funds, bigger pension funds, etc., have not been allowed to invest in oil and gas projects anymore because of carbon neutral and all that stuff. To a lesser extent has this come into the mining industry. And I think when you look specifically at the mining industry, it does throw up some real serious conundrums and challenges. For instance, if you look at ESG policies, just as much as we all think it's the right thing and it's good and everybody wants to do it, I mean, how do you square the circle with all these good intentions and wanting to create the good conditions and the right conditions and climate change and electric car vehicles, with the fact that 2/3 of all cobalt currently is located in the DRC? How are you going to square that circle? I mean, how is an investor based in London or New York going to impose that on the DRC when we know that so much cobalt is located there? How are you going to get that out with? I mean, it's nice talking, but there are some serious choices that you will have to make in the short to medium term if you really want to achieve electric cars all over the place, because of the way the Earth is constructed today and where we know the materials are based. So you will have to make some choices. You're not going to revolutionize the politics of the DRC tomorrow, I can tell you. Many have tried, and DRC has the commodity curse like some other countries have. And there are so entrenched interest and stuff that, good luck showing up with that ESG sign. It's not going to be fixed tomorrow. So that's just one example, and it puts a little bit at the head. Obviously, there'll be other places in the world where you have lithium mines and stuff where it might be a little bit more friendly jurisdictions or easier jurisdictions to operate in. And yes, there will also be some mining companies that actually are proud to implement all these things, and they can implement it. For instance, their energy generation might come from solar powered systems, etc. So we will see it more and more, there's no doubt. But fundamentally, in certain places, and certainly the scarce commodity places, you will have to make some very difficult choices.
Yeah, it seems I've always sort of maintained that to really decarbonize this supply chain and get to a realistic sort of EV penetration level, everybody along the supply chain is going to be a little bit unhappy, whether or not it's the environmentalists or The mining companies who, you know, Aline, to your point, are going to experience some cost inflation, which might hurt returns. Nevertheless, it's this again. We're here to listen to you guys. So, Matt or Jessie, any thoughts on ESG? Matt, why don't you start?
Sorry.
No problem.
Who's going first? Me?
Yeah, go ahead.
Do you want
Matt.
to go first, Jessie?
Yeah, you go first if you want. Yeah.
Okay. Yeah. So I would say from the pool side, from the demand pool side of things, we are seeing a lot of focus on ESG in the battery materials industry from the automakers. So particularly the European automakers are engaging all the way along the battery value chain with suppliers from the raw materials side into the anode and cathode side and up to the battery and the cell maker side of things. So from that side of things, we do have the automakers sort of keeping the industry honest, if you will. From a very top-down point of view, and I market to some ESG investors with my fund, and I would say there is a disconnect between the ivory tower that a lot of ESG investors live in and the real world, insofar as if you genuinely want decarbonization, then you have to recognize that you have to support the mining industry. And it is important that ESG investors engage with the mining industry so that we get operations that are ESG compliant, because there are a lot of mining companies out there that would want to be more ESG compliant. So it's important that ESG investors engage with the mining industry rather than saying, mining, dirty industry, not going to invest in it. Because by not investing in the mining industry, we get to the point where we were discussing earlier, where there's a lack of supply in the market, which drives prices up, which puts the energy transition effectively on the brink of not happening because it's not viable. Within the different battery materials, and I'm sort of rushing through this because I think we need to talk about other things, but within the different battery materials, there are a sort of different areas where there are areas which are more ESG compliant than others. So for instance, in Canada and Brazil, a lot of power is coming from hydroelectric. Therefore, areas like nickel production, graphite production is going to be more environmentally friendly than it is, for instance, producing laterite nickel in Indonesia using coal-fired power. You know, Western Australia is a core area for production, and there's a number of life cycle analyses being published by Western Australian companies looking at how they can lower their greenhouse gas emission profiles. And it looks like being things like producing byproducts from lithium hydroxide refineries to cut the amount of miles that you're transporting raw materials, using renewable power for your mine sites, and elements like that. So the industry is looking to improve itself by lowering its greenhouse gas emission profile, but it's a long-term situation, and it needs continuing support from the market. And as Aline mentioned, it's going to be expensive. So, you know, I think my takeaway would be that the industry can change itself, is working to change itself, but it needs support from investors all the way along the value chain.
Jessie, ESG thoughts?
Yeah, so I think mining company is getting serious about ESG, and in the past, when we look back to 2016, 2017, it wasn't their top priority. Now ESG is top priority for most of the company. I think the decarbonization push by the government and also disruptive technology applied to battery sector really help. And taking the lithium or graphite mine, for example, if they could really provide the lowest possible carbon footprint from the upstream processing plant to all the way down to downstream supply chain, I think they can attract a very low cost capital from ESG investor and also from the government funding.
Yeah, low cost of capital. That's something we've seen with green bonds, for example, right? Let's shift. There are a few other topics we want to chat about, or I'd like to get everyone's thoughts on. Maybe shifting now to geopolitics, because it seems like geopolitics is something that is a much bigger factor in the battery metal supply chain now than ever before. And of course, you can't talk about battery metals, can't talk about geopolitics without a discussion of China, which has always sort of been the 800-pound gorilla. I guess my view now is when you look at stimulus, whether or not it's here in the United States or possibly in the EU, it seems like there's really a three-way competition to build out these supply chains. But I guess I'm just interested in the panel's thoughts around China. We have seen some, what I think I can diplomatically call some rather heavy-handed moves by the CCP in terms of cracking down on their tech sector and the tutoring business. I mean, do you think, and again, I realize that this is probably a sensitive diplomatic issue that we want to chat about, but I'd be interested in your thoughts on, how, as China evolves and remains a very large part of this battery supply chain, is the crackdown on some of the industries that we see, do you think that's a threat at all to the battery metals build out? And if so, do you think that's sort of an opportunity for investors and companies outside of China to really build out these supply chains? Kind of a big question, but really thought it would be an interesting one. I don't know, Jessie, do you want to maybe offer some thoughts on your take on China and what's happening over there?
Yes, we see a lot of crackdown on different industries, but maybe we'll just narrow down to the EV industry. As we know, China is the dominator of the supply chain of the EV side. So I don't think it's realistic to decoupling from China in the short run, because we do know the facts. But I do want to touch point on the outside China. So due to the regulatory push, green economy is not only Chinese story. We will see China and Europe continue to be the dominant EV market out to 2025. And also Europe has caught up to China and roughly equal to EV market shares about 41% in 2021. And also in the US, there will be really limited impact in 2021. But in 2022, we will start to see the increased adoption as we see a lot of compelling local models out to the market. So we see the rapid growth of EV demand and also the domestic push. So I think self-sufficient is really important. So in the long run, we may see the battery being produced outside of China.
Aline, I see you nodding your head. Obviously, you've got some thoughts here. Maybe, shifting a little bit from China, but talking about the stimulus that we've seen coming out of COVID. I mean, if you just look at Stellantis and General Motors and some of these other major OEMs are talking about literally over $100 billion focusing on EV and AV investments just in the next 5 to 9 years, if you go out to 2030. So just curious on your thoughts around, how is the stimulus going to get spent? What does it all mean? And is it going to be effective in terms of supply chain build out and competing with China?
Yeah, I think if you combine those two factors, the geopolitics and the stimulus, it becomes a really interesting picture for investors. So to answer your previous question, I absolutely think this is a great opportunity that should be leveraged on. I believe that more supply chains will become more localized as geopolitical tensions increase. There will be a push for that, and within that, there will be investment opportunities across the Western world. In terms of the EVs, I'm actually quite, and the overall stimulus that we're seeing from the Biden, I actually believe it is quite real, quite tangible, and also not priced in currently at any one SD of these metals. So if you do really believe that the US will achieve their target on EVs that has been just announced, you really have to rejig your numbers for nickel, cobalt, all of these metals, particularly after 2023, 2024, you just have another hockey stick in the demand instead of doing the flattening that most analysts have on their STs. So I think it prolongs the growth story, not just for now, but will be longer. And it also becomes an interesting dynamic because anyone that is in this industry has to manage this volatility. The last 10 years has only about been China. And it's really difficult because, you're then 100% dependent what, basically the Chinese government is stimulating or not, is reducing. It takes the industry up and down quite a bit. And now you have more other demand drivers. We have decarbonization, we have Western stimulus. So what we will expect is that these things balance out and you don't have only a single driver for commodity prices, which should be healthy for the industry overall. China will always be very, very important. But, my estimate is that will be not only the only game in town for these metals.
Excellent, excellent. Perry, your thoughts on sort of the geopolitics here?
Yeah, I mean, there's no doubt the geopolitics will continue to be a very important factor. We have seen it most recently, obviously with all the stuff that's going on in Afghanistan and stuff. The things are really coming to a head now. And Afghanistan, incidentally, obviously having one of the biggest lithium resources in the world. So they are, geologically, they're very endowed. Politically, everybody has tried to help out and failed. So it sort of brings it all to the fore. So I think we'll probably see an increased focus from investors on geographical location or jurisdictional location of the actual assets, perhaps more so than was the case 2-3 years ago. Where there were times where people were willing to go to places where only the angels would dare to touch down and stuff. So now maybe there's a little bit of retrenchment also coming out of COVID. And yes, there's a quest for resources and stuff, but you still have the supply chain issues. And if you take that into account and then you look at where the resources are located, there probably will be a little bit of a preference, enhanced preference, shall I say, for good jurisdictions, and you could translate that into stocks for companies that has good jurisdiction. Projects will probably increasingly trade at a bigger premium to what they did before, and perhaps rightly so.
Interesting. Matt, thoughts on geopolitics?
Yeah, I mean, I think the other point that I would make about decentralization away from China of the supply chain is it's very positive for ESG as well. Particularly for greenhouse gas emissions, because if you look at the Chinese power capacity base, it's very much based on hydrocarbons, and you've got all of that processing, you've got synthetic graphite, you've got graphitization, you've got nickel processing, copper processing, etc., lithium hydroxide conversion, etc. That's all run off quite a hydrocarbon-rich grid. So if you're able to decentralize your supply chain, particularly the midstream end, away from China, then that's a very positive aspect from the ESG perspective. Just on the viability of decentralizing, so far we've seen a number of announcements at the battery end of the business, at the cell manufacturing end of the business, but we're still lacking announcements at the upstream end of the business. And it comes back to this point that we made earlier about planning, local government planning and national government planning and incentives for the mining industry. It's becoming increasingly difficult in Europe, in the US, to get mining projects off the ground. And if you're genuinely serious about building localized supply chains, then you need to invest in upstream as well as midstream and downstream. And that's the issue that we have to deal with at the moment.
Excellent. And this is another great kind of segue, but I want to shift now and talk a little bit more, coming back to the whole supply issue. I think we're all in agreement generally that there is going to be a pinch at different points in the future, whether or not you're talking about lithium or cobalt or nickel. What role does technology and what role will technology play, in your view, in terms of alleviating some of these potential supply pinches? And if we're talking about specific technologies, there's a lot of buzz out there these days around direct lithium extraction technologies. Again, kind of an ESG play, but also designed to ideally add more supply in a hurry. At least that's the sales pitch. And also battery recycling, which we've seen a couple of companies in the West here in particular raise several $100 million, one through a SPAC and one privately. Of course, Lifecycle and Redwood are what I'm referring to. I think in advance of this potential again, ESG nightmare from the spent battery angle. But again, I don't want to ramble on. What I want to do is hear from each of you, your thoughts around technology. You know, as investors, are you actively looking at and evaluating these technologies? Do you think they're going to make a difference anytime soon? Again, very broad topic here, but Per, why don't we start off with you and your thoughts on technology in the battery supply chain?
Yeah, I don't think that's going to change life in the short to medium term dramatically. I think you're faced with bigger problems that I doubt technology can just fix miraculously overnight, unfortunately. So I'm a little bit skeptical on that. Yes, there's some very exciting things going on. Yes, there will be new innovations happening that we don't know about today. We all look forward to those. But fundamentally, you have a backdrop where there are some serious supply demand issues, all the issues we have been discussing here on this conference call. But and those are going to be the main drivers, and a lot of it is down to the getting the lithium out of the ground in a traditional manner, at least for a foreseeable future. Getting the graphite out of the ground, etc., and there just are a lot of demands. And then when you go to the likes of nickel and copper, there are lots of other demands on that in the construction industry and in more traditional uses of this. So, and you're going to have to compete with that at the same time. So you could very easily see squeezes, not just with a narrow battery metals hat on, but a broader economic hat on, because we are going to bounce quite aggressively out of COVID from an economic perspective, and this will lead to big demands. And we are seeing some of these bottlenecks now. I don't think, whilst these bottlenecks are substantial right now, I don't think they're going to go away immediately. They will get better because efficiencies will come in, supply will come in, and it will get better. But you're still going to have, it's going to take longer. It's not a quick fix, and I don't think technology is going to miraculously just help us all out overnight. So no, we'll have to be a bit more patient.
Interesting. Jessie, I saw you nodding your head. Any thoughts?
Yeah, I have a different view on that. I'm a big fan of battery technology. I believe technology would be a game changer for lithium supply chain, in particularly for brine project. When we look at the 2020 production, according to industry data, it was 300,000 tons lithium carbonate equivalent, and two brine projects in Chile operated by FQM and Alabama make up about 20% of it. We understand brine projects involved with the evaporation process. It's really time consuming and also very subject to the weather condition. But with the lithium direct extraction process, they remove the evaporation process and faster to production and lower the impurities and also higher the recoveries. I do understand one of the key challenges here is how to scale up from the pilot plant. So I look forward to see something to be seen in the future on that front.
Okay, interesting. Matt, your thoughts?
Yeah, so I understand the excitement about direct lithium extraction. My concern is that it's not an industry-wide technology. So direct lithium extraction has to be tailored for each specific project. So it's not something that you can sort of put in a plant and effectively run everything through and it sort of goes through. So you're looking at different solutions for different resources. And I think the other point to bear in mind is if we look at all of the new projects that have come in battery materials over the last 4 to 5 years, they've all been delayed. And they've all been delayed because it takes a long time to hit spec. So these are specialty materials at the end of the day. And it's been taking longer and longer to hit the specifications that the cathode makers, the anode makers, the cell suppliers need. And I think it's going to take longer than the market necessarily believes to bring a lot of these new techs in. Just from the point of view of new techs, I also want to talk about the demand side of things, because we are seeing substantial new techs in the battery space as well. And that could also change the demand for materials. So we've already seen lithium iron phosphate batteries, LFP batteries, come effectively back from the dead in the last 2 years, which has very much changed the nature of demand for materials away from ternary NCM raw materials back towards lithium and iron phosphate. Increasingly over the next few years, we're likely to see focus move to the anode in the battery. All of the research really in the last 5 or 6 years has been on the cathode side. The anode side, particularly changes to silicon, adding silicon into anodes, could lead to significant changes in the breakdown of demand going forward. So I think we have to be aware. Having said all of that, I am excited and I am monitoring new technologies, but technological developments are not in my base case. I don't invest in any companies with a view that they're going to make a technological advance. And that's unfortunately based on experience. I've been a mining investor for many years. And unfortunately, my experience has been that new technologies tend to crash and burn in the mining industry. So I look at everything with a certain dose of that reality, unfortunately.
Healthy skepticism. Yes, I think you and I have both had our fingers burned more than once. So anyways, look, I mean, another great example is CATL and their kind of announcement of a sodium ion battery. And that took a lot of people by surprise. But again, Matt, to your point, okay, so this isn't necessarily something new, but this isn't something that's going to revolutionize this market tomorrow. It's going to take time, and it may not affect, the energy storage market relative to automotive. I mean, there's just a lot that we need to understand before the dust settles. But anyways,
I think the point with the cattle battery is that, as Aline said at the beginning, we have pretty good, there's been a lot of investment in this space, in the cell factories and everything. So we have pretty good visibility, at least for the next 5 or 6 years. What are the technologies that are going to be in use? Beyond that, maybe we'll start to see changes in technology on the demand side, but at least for 5 or 6 years, the factories that are under construction now are either NCN or LFP. So we know what the demand is going to be on the materials side. Sorry. Go ahead.
Nope, absolutely. That's a great point. And that's a great runway for investors too. This isn't sort of an overnight success story. Aline, please finish us up here on the technology.
A technology will be not long, but I do think we have some success stories in the mining industry. I know it's hard to believe because we see these mines being built exactly as they were 30 years ago, but there are technologies that have revolutionized the supply for these metals already. And I don't have to go far, but just MPI as an example. It doesn't have to be a breakthrough technology that will bring lithium for free out of the ground or make batteries, 100 times cheaper. But a technology such as MPI have revolutionized the nickel supply chain and allowed for us to be here where we are with 4 million electrical vehicles on the road and stainless steel. So I do believe there will be continued technologies as such. And not only, as we mentioned, it's not only at the mining side, but mostly on the battery and substitutions from other sectors, which we've seen as well. Cobalt, for example, the use of cobalt in other sectors, non-battery related, is reducing. There's been some substitution there, stainless steel grades with lower nickel. So we're going to see less use and technology being smart about using these precious products in other applications that will create additional supply.
Okay, and let's stay with you maybe on this next topic, and we've alluded to it, but we haven't really dug deep, and that is, of course, financing. How to get a lot of this built. We've talked about General Motors and Stellantis and these other larger pools of capital coming in, but how do you think the battery metals supply chain in the market is going to evolve from a financing perspective? I mean, are we more likely to see more streaming deals? I know carbon streaming is kind of the new hot thing. Or is it just going to be a traditional, straight equity, debt, project financing? I mean, how do you see financing for battery metals projects evolving?
Yes, I think streaming deals are extremely interesting structure for investors like us that take a longer view on this, where these prices will be. And we can take high conviction that, that will be quite interesting, and it decreases the risk for the mine because it's only giving up some upside and it's not, and the security in the structure. So I think that is a quite interesting structure, but in the medium term, my guess is more related to what Matt said, is that you start seeing ESG money being put into mines. And that's a pocket of capital that is about 50 times larger than the capital that we see. It's specialized in metals and mining. So what is likely to happen and what will fast track this is that as ESG money recognize the need for these mines and come in, as we've seen with solar panels, the cost of finance will eventually reduce for building these projects. I think will be the trend. We had to address the risk of ESG. Again, it goes back to ESG. How does the capital get comfortable that there's some environmental management necessary in the sector? But I think that's the way the trend will go.
And who, just to follow up on that, and then I'll hear from the rest of the panel, but who sets the standards for ESG criteria? In other words, to qualify for green bonds. Isn't that sort of one of the issues that I think the industry is struggling a little bit with right now? Like, is it just a question of, okay, well, let's rely on the United Nations to set the standards, and if we hit these 17, mileposts, then everything's fine? Or, how do you at Pala view criteria and mileposts for ESG goals?
So I think that's a great example of a challenge of the industry. We are Pala take this very seriously, and we subscribe for the UNPRI as the sustainable investors. But it's really, really difficult, even in the main, when you look at companies, the main ESG providers of information rank these companies completely different. So sometimes you can see one company ranked as top #1 performance on ESG, and just to say a name is sustainability, then it will be, low performing in another standard. So I think what we have to do is really gather together into one standard that we see and standardize the reports. I think this trend is already happening. So if you always start with the largest companies, so you're already seeing Anglo and Rio, the reporting starting to look the same, starting to show the same information, starting to send, in the same place of the report. So you don't have to go through 200 pages to get, similar information on each. I think it starts with as simple as this is the table you fill, and this is where the table goes. So you can start ranking. I think that movement is happening. And in terms of standards, there are a couple of specific mining ones. You got the IRMA that is trying, in steel, you got the Sustainable Steel Alliance. And at the end of the day, one will be, the leader of these, and we will report according to this. So right now, we check all of them. It's hard to say which one will win as a standard, but the tendency is that we prescribe to one, and we say this is how we report. These are the criteria, and these are the standards, which is highly necessary. Right now, it's extremely labor intensive to be an investor that cares and ranks ESG in a responsible manner, because you have to look for different things in each project in each company.
All over the place. Matt, I see you shaking your head, or nodding your head, I should say. Your thoughts on financing here.
I was nodding my head because I feel Aline's pain, because I've had to do that as well, particularly in the sort of mid-cap small end of the business, where it's very, very difficult to get ESG disclosure. Interestingly, also in the midstream and the downstream space, so the cell manufacturers and the cathode and the anode manufacturers as well. So it's not just an issue in mining. I would say that all financing methodologies are probably on the table. And as Aline says that the ESG area is an untapped resource, I think one of the areas where we should see more investment coming from is OEMs. It's in their interest to invest in supply. What we've seen up till now really from OEMs has been them locking in offtake agreements. But we haven't really seen very much in the way of capital flowing into the mining sector from OEMs. And if you look at, the big OEMs, the top 5, they've all got net cash positions. So why aren't they applying that cash to supplying the raw materials that they're going to need going forward? From the point of view of the OEMs, by investing in 5, 10, 15 projects, they are effectively ensuring that there's enough material, preventing raw material prices from going very high and very volatile, which is in nobody's interest, and generating a return for themselves. So I'm very surprised that we haven't actually seen the OEMs come in and deploy their balance sheets in the sector so far in this cycle. And I think we really do need to start to see that going forward.
Excellent. Perry, your thoughts?
Yeah, just picking up the last point from Matt. What I do is just look at the cycle of a company, a mining company, etc. I think there's a plenty of capital available if you're near-term production. If you're at the BFS or DFS stage, there is tons of capital available because of the supply-demand dynamics we've been talking about this call. And if you combine the fact with a lot of capital willingness or investor willingness, certainly for the good jurisdictions, combine that fact with, on average, in most mining companies, the management team and or the board tends to be older rather than younger. It's very rare you see a serious mining company being led by a bunch of kids or young people, etc. So it tends to be older and therefore more traditional. And given there is more traditional capital available for near-term projects, that's what you go for. I mean, it is you have a lot of people who are very advanced and when it comes to geology and all sorts of things, but quite risk adverse when it comes to being creative on the financing side. So I think, and given there's plenty equity available and debt available, you just do what you always have done. So that's for the near term, BFS, DFS. If you go further back in the company life cycle, exploration capital, exploration equity, scoping study level equity, PFS equity, pre-feasibility study equity. That's where the challenge really is, because you still have a bit of resistance of people willing to fund that in general. And without the funding, the risk-taking on the equity, on the pure equity side here, and the support of all these great geologists running around looking for these things, you're not going to have enough sort of running through the food chain and developing projects to become BFS and DFS ready eventually. So I think that's really where it would be nice to have some more capital going into that space. But if you look to the OEMs or other, or even the ESG-focused investors, they are probably unlikely candidates to fill that gap because they would again focus on the more mature, they're a little bit less familiar with it, and they'll probably go for the bigger listed, closer to production or in production company looking to expand production perhaps or so. So I think what the real challenge is on at the earlier stages of a mining company cycle and getting the equity in, because there you are left with the usual suspects of equity investors, and if they don't show up or they're a little bit more hesitant, what are you going to do? There's not a lot of other people you can call. So that's my assessment of the capital. But near-term production, plenty of capital available.
Excellent. Jessie, your thoughts on the financing?
So yeah, I agree with Pat. In terms of the short term and medium term, I think the project financing can come from traditional way, either from equity or debt financing. But I do want to touch point on the carbon streaming model. It seems like very new for us, like in so many different ways, and we do want to see how it performs in different market environments. And I do view it as the risk mitigating mechanism, either transfer risk or manage the risk better along the supply chain. So I do feel like the streaming and royalties model is really encouraging.
Interesting. All right, listen, guys, we are just about out of time. Unfortunately, I know we could go on for a lot longer, but we're in different time zones and we've got busy schedules. So with that, we'll end with kind of a pie in the sky question, if that's the right way to put it. I'm just curious on maybe if you can leave us with your preferred metal or your preferred opportunity along the supply chain. Jessie, I know you just talked about carbon streaming as an example. I don't know if that's what you'd like to stick with, or if there's a specific thought or metal or anything that you're optimistic about over the next few years.
Well, I'm not going with the royalties, but I'm a big fan of EV. So I would say in the next few years, I believe EV adoption continue to accelerate. And according to third-party data, again, at first half of 2021, EV sales at the total number of 2.53 million units, and represent 164% increase compared to the previous corresponding period. So I believe the growth continues to be driven by China and Europe, and because of the government investment for EV and charging station, also supported regulatory framework and also the falling battery costs. That's my thought.
Excellent. Matt, your sort of preferred theme or metal or idea over the next few years?
So I batted a few around, but I'm going to go for high purity manganese because it's such a misunderstood material. Everybody looks at the manganese market and they go, oh, there's loads of manganese in the world, it's not a problem at all. But high purity manganese has very, very specific chemical criteria, and probably only 2 or 3% of the manganese deposits in the world are actually viable to manufacture high purity manganese at any reasonable economic or sustainability level. So yeah, for me, high purity manganese is the most interesting niche.
Interesting. Thank you. Aline, your thoughts?
Matt just took my idea.
Oh, sorry.
So from one, another one out there. Well, first one, I would do a basket because I do believe all of these metals have great fundamentals. But since that one idea went out, I think NdPr outside of China is quite an interesting segment as well for the amount of magnets you're going to need for the electrical vehicles in general. So that would be, a third idea.
Okay, excellent.
But the manganese is an excellent one.
That's your top one. That's good to know. Good to know. And Perry, your thoughts?
Yeah, for us, it would be near-term production within base metals such as copper, nickel, zinc, and would also add the manganese element to it. And then precious, if we widen it up a little bit, so the gold and silvers of the world, which we also like a lot. And then finally, within battery specifically, it would be lithium and manganese, if you want to put it down there. So yeah, so those would be our things. But near-term production is kind of our favorite.
That's the key. All right, excellent. Well, listen, Jessie, Matt, Aline, and Per, thank you all very much for your time and your thoughts. This has been a fantastic panel, and very pleased to have served as the moderator. So thanks to Andrew and the folks at Mines and Money. And of course, also thank you to everyone who has tuned in. Looking forward to keeping the conversation going. So thanks very much, everybody.
Thanks a lot.
Thank you.